Hey everybody, John Duncan here, and I want to talk about qualified accounts and specifically for people that have at least $1 million or more in net worth, and why I believe that qualified accounts are such a bad choice and basically the default choice of most CPAs. And what I want to say about it is this: when you create a qualified plan, a lot of times, first of all, a lot of times the reason people get started in them is when they start their business, and they're starting to grow, they start making a little bit of money, and then it comes tax time and they owe taxes and they say, well, how can I cut tax? Well, just open a qualified plan. And it does work. It'll, reduce the taxable income and thus reduce the taxes. However, a it is simply a deferral. It is not a deduction. And here's the difference between the two. In a deferral, all you're doing is kicking the can down the road. And meaning it delays the tax on the money that's deferred, but it also delays the tax calculation. I want you to think about that for a minute. We're in a situation where the government is spending over $1 trillion a year that they'll admit to, more than they bring in. And that's in the midst of a great economy. When qualified accounts started was back in 1978 when the top tax rate was 70%. So it made sense back then to say, okay, I can defer X amount of dollars because I don't want to pay 70%. And someday the tax rate may be lower. I might be retired, whatever. And so I'll wait till then to have the tax calculation. These days, the top tax rate is not 70%. It's not anywhere close. And to defer, you're deferring into the potential of the government at some point changing the tax rate, and it could be much higher than it currently is. Since 1913, when they started the income tax, the average of that whole time is 57%, the average top tax rate. So we're actually well under even the average at this point. And I'm just talking on the federal side. So for my clients that are making really good income and have substantial net worth, I am always talking to them about not doing qualified money at all, looking at other alternatives. So, what are alternatives? One of the alternatives would be like a conservation easement. If you're not familiar with those, you can Google it. But basically, it's a deduction, it's an actual deduction that gives actual deduction back to the client, and pretty substantial at that. It can be done year to year. It's not anything locked in like a defined benefit plan would be. So that's one way. Another way is what we call a 401k condo. So instead of putting, say, 100,000 into a retirement plan, take the 100,000 and put it into maybe a second property, and take a loan and so forth, and you'll create a tax deduction on the interest, but you also have a tangible asset that, as it appreciates, unlike a qualified plan, creates some liquidity. And at the same time, when you die, let's say you kept it till you died, it would be taxed as a stepped up basis. So it would save a fortune in taxes. And so that's just a few of the reasons. Now, the other side of qualified plans is I've been in the financial industry for 30 years, and I've seen a lot of my clients die, old age, whatever. The worst account that they ever have is that qualified account because it's taxable completely upon withdrawal as income. The worst type of tax you can have, income tax. The other side of it is, what if you need the money before you're 59 and a half? It's not liquid at all. If you try and remember in 2008 when we had the meltdown, people were going into the 401ks and paying 60% in tax because of the regular tax, state tax, and then the penalty. So who is a qualified plan good for, though? It's good for employees that are making 50,000, 60, 70,000 a year because they're going to go and fund it, and they're not in a huge tax bracket to start with. When they retire, they'll have Social Security and their tax rate won't go high. Why I caution my clients, which I work only with high net worth clients, against qualified plans as well, is they also have other assets that are producing income. And I always ask clients that have big qualified accounts, do you want to lock yourself permanently in the highest tax bracket? And they always say, what do you mean? I said, well, this thing here, factor it out at age 70 and a half when they have to start taking it out, is going to be added to their Social Security. It's going to be added to other income they have coming in. They're going to be locked in the highest tax bracket from then on. It's like a devious plan by the government. Again, I think it's great for like a regular employee. I don't think it's great for business owners and people with high income. So with that is the end of this, but I just want to say, totally against qualified accounts for high income, high net worth clients. The alternatives are conservation easements, real estate. Another possibility might even be insurance plans. There's all kinds of other alternatives. And the way that you can kind of tell whether you're advancing in sophistication with your money isn't how much you make, isn't how much your net worth is. It's, are you seeking out better tax strategy than just kicking the can down the road and staying in a government controlled plan, which is what nobody wants. So anyway, John Duncan, if you have any questions, send me a message. Anyway, have a good afternoon.